The ledger is already wrong. No one in this room knows it yet. The number on the page was built on an assumption that no longer holds. A city makes a promise. It is written into employment. It is binding before the money exists to honor it. The assumption is 8% annual return. It has been 8% for 30 years. No one voted to change it. Actuaries submit their projections. The projections are reviewed. They are approved without revision for the 11th consecutive year. Public workers retire. The checks begin. The fund pays out more than it takes in. The model says this is temporary. The gap opens. It is not visible from the outside. Inside the structure, the distance between obligation and asset begins its widening. The board meets quarterly. The agenda follows the same order it has followed since the fund was established. Nothing in the structure asks new questions. Contribution rates are set by statute. Changing them requires legislative action. Legislative calendars are full. The rate holds. A generation of workers enters public service. They are told the retirement is secure. The guarantee is institutional. It is also unfunded. The stock market rises through the decade. Fund valuations rise with it. The gap narrows on the surface. The assumption stays in place. Cities negotiate new contracts. Enhanced benefits are offered in lieu of wage increases. The pension obligation grows. The budget line does not reflect it. The actuary files a note of concern. It is received. It is filed. The meeting proceeds to the next item. Decade end approaches. The fund has grown in nominal terms. The obligation has grown faster. The difference accumulates in silence. A new decade begins. The fund enters the globalization era with its assumptions intact. Returns are still projected at 8%. Liabilities are still growing. Equity markets expand. Pension funds allocate heavily into equities. The expected return feels defensible. The underlying obligation continues to compound. Municipalities issue new bonds to cover operating shortfalls. The pension remains off that accounting. Two separate clocks now run in the same building. A council member raises the funding ratio in open session. The ratio is 82%. The room treats it as satisfactory. 82% sounds like most. What it does not say is how the remaining 18% was calculated, or when. Pension boards are populated by political appointees. Terms are long. Turnover is low. The institutional memory holds the original assumptions without friction. The dot-com contraction arrives. Equity valuations fall. The fund absorbs the loss. The assumed return remains 8%. The board does not lower the assumed return after the contraction. There is no procedural mechanism requiring them to. The model continues as written. The unfunded liability is now measured in billions. It appears in footnotes. It is not a headline. No council session is called to address it. Independent auditors review the fund annually. Their mandate does not include questioning the assumed return. The audit passes. The assumption continues. The market recovers. The fund recovers with it. The board notes the recovery. The gap beneath the recovery is not noted. Benefit enhancements are retroactive. Workers who retired years prior receive adjusted payments. The obligation reaches backward into time. The fund did not grow backward with it. There are now more retirees drawing from the fund than workers paying into it. This ratio has been crossed. No alarm is built into the structure for this crossing. Those who track this system closely understand that the record of what was promised has never been fully assembled in one place. Sustained attention to these accounts is what makes the gap visible at all. State oversight agencies receive annual filings from pension boards. The filings arrive on schedule. The schedule was designed before the liability reached this scale. Pension obligation bonds are issued. The city borrows to make its pension contribution. The debt is now funding a debt. The housing market peaks. Municipal tax revenue follows. Both begin their descent in the same quarter. The pension model does not register either event. Tax receipts fall. Then, city services begin absorbing small reductions. The pension payment is protected by contract. Service budgets absorb what the pension cannot. The financial crisis arrives. Equity markets fall 40% in a single year. The pension fund falls with them. The assumed return remains 8%. The board meets in emergency session. It does not change the assumed return. It approves a smoothing mechanism. The loss is spread across future years. Smoothing is a legitimate actuarial technique. It was designed for minor variance. It was not designed for a 40% equity loss. The technique does not make that distinction. Cities begin deferring their pension contributions. The obligation does not defer with them. Deferred contributions compound at the fund's assumed interest rate. The gap widens faster now. Municipal workers continue to pay their share. Their contributions arrive on schedule. The city's matching contribution does not. The imbalance is absorbed into the structure silently. State legislatures are asked to intervene. Some pass enabling legislation, allowing further deferral. The intervention extends the problem. It is reported as relief. Credit rating agencies review municipal bonds. They note pension underfunding as a risk factor. They do not downgrade. The bonds remain investment grade. The unfunded liability is now 70% of the city's annual operating budget. The number exists in a filing. The budget is presented separately. The two are never shown together. A city misses its pension payment entirely. It is the first missed payment in the fund's history. The structure does not absorb this. The mechanism changes state. Retirees receive letters. The letters do not say the fund is in distress. They describe a review process. The review is not defined. Reform proposals circulate. Each proposal is met with actuarial objection. Each objection is met with legal challenge. The cycle continues for 2 legislative sessions. Courts hold that pension benefits are contractual obligations. They cannot be reduced unilaterally. The legal protection was written for a different scale of problem. Active workers are asked to contribute more. Union contracts require negotiation. Negotiations stall. The contribution rate does not change. The pension fund begins selling assets to meet current payments. Liquidation at depressed valuations locks in the crisis era losses. The fund's capacity to recover diminishes with each sale. Some cities reach insolvency proceedings. The pension obligation is listed among the creditors. The retiree is now a creditor of a city that cannot pay. Federal law does not protect municipal pension recipients the way it protects private sector pensions. There is no federal guarantee fund for this category of obligation. The gap has no floor. Bankruptcy court approves a pension reduction. It is the first of its kind under this municipal insolvency framework. The legal precedent is set in a single proceeding. Other cities observe the precedent. They do not accelerate reform. They note that the precedent exists. The noting costs nothing. The liability continues. States with constitutional pension protections face a different constraint. The Constitution protects the benefit. The Constitution does not fund it. The protection and the insolvency coexist. The total unfunded municipal pension liability across the country is now measured in trillions. The number is revised upward each year. Each revision is absorbed without structural response. New workers enter public service under reformed contribution terms. Their benefits are smaller. The obligation to prior retirees remains. 2 tiers now operate inside the same institution. The actuarial models are updated. Some cities lower their assumed return to 7%. The gap does not close. Lowering the assumption makes the liability larger. not smaller. The workers who were promised the retirement are now approaching it. The promise has not changed. The fund behind it has. They do not yet know by how much. The system continues. It was never designed to stop. The promise remains on record. The gap between the promise and the capacity to keep it is now the defining feature of the institution.